Well, a very good evening this Thursday, the 2nd of October. It is 6:30. It is a windy evening here in central Cape Town. And if you can hear some nibbling in the background, it certainly isn't the ants or the termites in my house. It's the dog sitting underneath my home office desk here chewing on his beef bone. As you know, wherever I go, the dog goes with me. I think year to date, the market has been remarkably strong. Excuse me, I think we all know last year, 2024 was the year of a small cap market. It was up over 50%. But yes, this year it has completely flipped. The Aussie market closing today at 108,090 is up 24.7% year to date. The mid cap index, which literally was lackluster up until about 2 to 3 months ago, is now up 16.1% and has been incredibly strong the last 2 to 3 months. The small cap index is only up 4.75% year to date, but it was down about 6, so it's recovered its poise, but it's certainly nowhere near the gains seen in the mid cap and in the Aussie. And just for a comparison's sake, we all know that if you weren't in Naspers, Prosus, Anglo Gold, or Goldfields, then quite frankly, you've made no real money this year. The Resi is up 118.7% year to date, driven by the gold stocks and latterly the platinum stocks. And interestingly, the Finny, which comprises the listed banking stocks and insurance and financial stocks, is only up 3.5%, showing you that all the action has been in the hard assets, and perhaps the more financial stocks have been left behind. So it's the Rand hedge stocks and the large dual listeds and Rand hedge stocks that have done fantastically well year to date. I was checking the 52-week closing highs earlier in the universe that I operate in, and Weaver Tech, the new name for Home Choice, the catalog company which is morphing itself into more of a technological play, offering loans and all sorts of financial services to its customer base, was at a new high. Sabcap, which is a stock well known to listeners on this Rand Swiss webinar and to my clients, and of course those that follow me on my Twitter or X page, Small Talk Daily, hit a new high today of 122 Rand 50. Year to date, that stock is up 30.4%, but it did hit 126 Rand intraday today. And then Astral Foods, the largest poultry company in the country, also closed at a new 52-week high, 215 Rand 11 cents. But again, it was over 218 Rand intraday. Year to date, the stock is only up 12.2%, but I think it has significantly more to go. I was chatting to one of my counterparts online earlier, who's one of the leading technical analysts in this country, and I said that my fundamental target for Astral Foods is 135 Rand, has been 220. And we're knocking on the door of 220. He said, well, Anthony, technically the stock is good for 225. To which I promptly said, well, if it makes my 220 Rand target, which it nearly did today, my next target is 240, then 250. And he did not disagree with me. So on that ilk, I'm going to start off with some stocks that I think look interesting from a special situation standpoint. So I've got my pages of notes here, but I think it would be remiss of me not to open up this webinar preamble by discussing my top stocks of 2025. Year to date, it's been a very mixed bag. As of the end of September, the portfolio was only up, it was down 0.69%. Again, the main action has been in the Aussie and the mid-cap index, but the top 10 has a very divergent view. There are two stocks, basically Cash Built and Hoskins Consolidated Investments, which have basically slammed my overall performance. If you took Cash Built and HCI out of the selection, which I'm not allowed to do because it is a top 10, things would look dramatically different. Cash Built year to date is down 32.9%. and HCI is down 22.8%. And from month 8 to month 9, Cash Built again was the weakest performer, down 8.3%, showing you that when I chose these stocks in mid to late December, when the underlying economic environment was looking particularly different compared to now. It's amazing how quickly the tide can turn against a stock, which in quarter 4 last year was riding high on the two-pot payout system, people running out and spending money on DIY and refurbishing their homes, buying paint, etc., etc. The stock was riding high. And as the two-pot system was shown to be nothing more than a damp squib, with a taxman making most of the benefits compared, excuse me, to the retail and the consumer sector, cash built in very difficult times is completely unwound. And when selected at 212 Rand, it got to a low of 120. We're now back roughly at about 139 Rand. Hoskins Consolidated Investment, again, has been a very lackluster play. The net asset value right now is trading at about 303 Rand, and the discount is probably about 61%. Now, again, at the beginning of the year, the underlying company was looking remarkably more choice as a net asset value play. Sadly, as many of you on this webinar will know, the underlying markets that HCI operates in regarding its largest investments, which is online, which is gaming via Sochel, and its oil interests via its exploration assets off the coast of this country and Namibia, have taken a dramatic turn for the worst. Online gaming, which has been not properly regulated by the government, has soared ahead. And I saw a statistic that came out from Stats SA last week from one of the retailing companies that I follow, that 54% of the average monthly spending of the low-end consumer, which is the real people who shouldn't be gambling, is now spent on gambling, be it some form of lotto, scratch cards, or other forms of online gaming, which is quite a dramatic surge, showing you that the largest area of consumer spending suddenly is gaming, rather than going out buying clothes and cell phones and food, which is actually quite concerning. And that is going online, which is certainly not benefiting Sochel with its bricks and mortar assets in varying casinos around the country. And with Donald Trump being the president of the United States and his drill, baby drill, yet alone other economic scenarios, we've seen West Texas Intermediate down to about $60. And as such, the underlying oil price, having traded at about mid-80s beginning of the year, has taken a lot of the luster and the shine off the oil assets inside HCI. And as such, they are sharply unwound. Now, I'm an HCI shareholder. I'm still sort of breaking even at these levels. And I'm convinced at some point that the long-term underlying net asset value of HCI will start to recover. And I have had discussions in the last few weeks with some value fund managers who are clients of mine who seem to agree. But we also have other clients of mine who are bailing out because they don't see any turn in this company for the next year or two. Because the CEO, Johnny Copeland, in the annual general meeting that was held at the end of August in Sea Point, didn't give any crumbs of comfort to shareholders. In fact, it was probably quite a patronizing AGM, where the CEO seemed to indicate that he knows best, and as such, shareholders and investors should just sit there patiently like children, waiting for him to do his job. And that may still be 2 years away. And I think that went down like a lead brick, or to use my popular vernacular, it went down like a bucket of cold sick, and the share price continued to sell off. But I think in due course, given that Johnny Copeland and the unions are the single largest shareholders, I think at some point with the shareholder activists now rattling the cage, you cannot have a company trading at around 123 Rand a share with a net asset value of 303. Something at some point will have to give. But sadly, some corporate restructuring, or as I would call shenanigans, occurred earlier this week, where HCI and the unions got into a cozy little deal where the company is now, in theory, I would say takeover proof, because over 25% of the shares are in a vested pool, which means cajoling and irritating management to try and unlock value will probably get nowhere, because just over 25% of the stock is held by a handful of individuals who are all insiders. So sadly, that has made things slightly more problematic for underlying investors. So those two were the worst. Looking at the best stocks in the portfolio, Grindrod is up 33.5% year to date. Now, we can remember that that stock at some point early this year was trading at substantially low levels as concerns regarding the earnings of the company, the resumption of the opening of a border to Mozambique, and the flows through the port of Maputo were concerning investors. That rapidly diminished in August as the company came up with a solid trading update, then very good results. The third party rail announcements were made by Barbara Creasy, the Minister of Transport, and the company was off to the races. And with the PIC having been selling hard their stock from about June onwards, and the stock was getting down to about 11 rand, 11.50. The corner suddenly turned, and the stock literally ran extremely hard in the months of July and August. So year to date is up 33.5%. We've got Nampak again. It's off its best. It's still up 10.7% year to date. And I see there is a question on Nampak, which I'll get to in the Q&A. We have seen a new CEO appointed in the last week or so. As a bit of a history, Phil Roux, the CEO, was on a time tenure, and he announced his departure as of the end of September. And the heir apparent was Andrew Hood, the Chief Operating Officer, who has done an exceptional job in running the underlying operating businesses. But sadly, I always get to know far too much as a former corporate broker. Sometimes you can't say in sense what the underlying reasons for a significant executive departure is. All I will say is, in this case, is that there's been a family issue. I wouldn't say it's a tragedy, but any form of issue regarding one's loved ones has to be taken extremely seriously. And he has just stepped down from the breach of becoming the CEO due to a very personal family issue, which, if you knew the reasons, you'd understand why he has stepped down to be with his family. And in the last few days, Nampak has appointed Rion Hale, who was the former CEO of Pioneer Foods, sorry, the CEO of PepsiCo SA, who I've known for the best part of 20 years, having listed Pioneer Foods in 2007. And he ran the essential foods business, then the marketing operation, and then he became the CEO of PepsiCo in 2023. With the restructuring of PepsiCo, which happened in the last few months, his position has been taken by another. And Phil Roux, who was formerly the CEO of Pioneer Foods, has basically recruited Rian to become the new CEO, and he will take over from Phil in February next year. So I see basically a fairly good continuity, but Phil has basically chosen somebody that he has supreme confidence in, who has a background in FMCG, and he will be stepping into the breach February next year. In terms of some of the other stocks, we've got PPC up 12.7%. We've got CMH up 5%. Advotech basically unchanged. And then RFG, Rhodes Foods Group, is down about 8.8%. So all in all, the portfolio is down 0.69. But if it wasn't for Cash Built and HCI, I think I'd be smiling from ear to ear regarding the underlying performance relative to the small cap, which year to date, as I said, is only up about 5%. So if there's any questions on any of those top 10 stocks, which is Avotec, Cashbuilt, CMH, Grindrod, HCI, KAL Group, Nampak, PPC, Rainbow Chickens, or Rhodes Foods Group, please put them in the chat box. But I will be talking about KAL Group, excuse me, and Rainbow Chickens in my special situations preamble, which will begin right now. I mentioned earlier that Astral Foods, the country's largest poultry company, hits a new 52-week high today, up 12.2% year to date, having been a little bit higher in the day at 218.17. Now, I track the poultry sector extremely closely because if you get the underlying timing right in a poultry company, you can make a great deal of money. It's a cyclical food company where much of the earnings is purely derived from the savings that the companies gain from better procurement of its main inputs, which is basically yellow maize and soya. If that is then tied into a rising kilogram price of chicken, which technically is called realization, and the fact that one of the biggest competitors in the sector, which is Daybreak, which has gone bust, you've got a number of very strong tailwinds that are assisting the sector. Now, internationally, avian influenza is quite endemic in many of the large exporting countries into this country. And we as a country do tend to import what I would call low-end products, mainly mechanically deboned meat, which goes into Vienna's, polony, and processed meat, because we don't produce enough. And that's the main import that comes in from Brazil. The contentious products, like the boneless fillets and the leg quarters, have diminished over the years due to tariffs. And again, avian influenza cutting off the imports. But as we stand here right now, I've been extremely bullish on the poultry sector year to date, and it has been the right call. Not that I'm blowing smoke up my own arse, but it is incredibly easy to track the potential capital gains in the poultry stock if you follow two simple metrics: yellow maize and soya. Yellow maize and soya make up about 60%, if not more, of the underlying cost of rearing a chicken. So I'm going to give you some very simple stats here. And they have to be simple because I'm really not that clever. Yellow maize year to date is down 36% to 3,439 Rand a tonne. It has been sharply lower because the underlying maize crop in this country is now up about 26% year on year at just over 16 million tonnes. Now, the soya price year to date is down 27% to 6,812 Rand a tonne. Now, I'm giving you these numbers for one very simple reason, because if you track what SAFEX does with yellow maize and soya, and when you see what is going on internationally, particularly in Chicago, where most of the global price of soft commodities are actually made, the world right now is awash with grains. Wheat, soya, corn, you name it, there is endless supplies because there's been very good crops from the United States, the Baltic region, Australia, the European Union, Argentina, and Brazil. And as such, global prices are benign. Now, you put that into context with a very strong rand. The rand is now at about 17.19 to the dollar, having been as low as 19.90 at one point. And as such, the cost of importing, particularly the coast, has become significantly cheaper. And as such, that aligned with substantially larger domestic production of field crops has seen a sharp decline in soft commodity prices. Now, why is that important? Because again, you have to know the underlying metrics. If you're Astral Foods and you buy roughly 800,000 tons of yellow maize a year to feed the near 5.2 million chickens that you slaughter every week. And as I was telling a client 2 days ago, at any one point in time in this country, there are 200 million chickens running around. And at any one point in the cycle, 45 million chickens are waiting to go to the abattoir to be slaughtered, of which around 22 million chickens are slaughtered on a weekly basis in this country. Now, these numbers are staggering. The domestic poultry industry is worth 70 billion Rand a year. So again, if you're Astral Foods, as the country's largest producer, producing 5.2 million birds a week, and Rainbow, as a comparison, produces about 4.6 million birds a week, and your main input cost, which is yellow maize from its peak, is down 2,300 Rand a tonne. That is a 1.8 billion Rand a year annual saving in input costs. Now, the numbers are very simple because they have to be, because I analyze them. You take that 1.8 billion Rand, you divide it by the number of shares in issue in Astral, and it spits you out a Rand value per share. And that basically kicks into the uplift in the underlying earnings potential of any poultry company. You then kick in a near 18% increase in the chicken price, and the fact the market has become a little bit more favorable because your competitor's gone bust and the imports have been choked off. And it is incredibly easy to forecast the underlying earnings uplift in poultry companies. And they are going to have an extremely succulent period of results. We saw Rainbow's results, which came out at the end of August. We saw a sharp uplift to the earnings there to about 66 cents a share, putting the company on a price earnings ratio of 6.5. We've got Astral's results to September coming out, probably in about late October, early November. And I'm expecting a trading update from Astral imminently. And then a second trading update before results. And I think the reason why the Astral share price is running is because the smart money knows they're going to come out with a really good trading update and then an even better second one ahead of results. So do I feel that the Astral price has got more to run? Absolutely yes. It becomes what I call a symbiotic relationship. It's a Mobius strip like this. As the poultry companies come out with very good results and the market sees stronger chicken prices and lower input costs, everyone starts to see higher margins and higher earnings. So when the Astral results come out in November, there'll then be expectations of the Rainbow results. So the interims to December will also be good. So Rainbow will start to run. When Rainbow results start being expected by the market in early 2026, that'll then feed through into the Astral expectations for their March interims. So it becomes a self-fulfilling prophecy. And with expectations next year that the underlying field production of soft commodities in this country will continue to be very strong, and the underlying global price of soft commodities remain benign, I'm expecting extremely bumper earnings from Astral and from Rainbow. So given that Rainbow year to date is down from its high, Rainbow just before results was trading at about 4.85. It recently fell to a low 4.03. I wrote a note a couple of days ago to my institutional clients, basically indicating that the reason that the share price fell by 20% from results at the end of August is extremely simple. Anyone that's had a look at the Rainbow Chicken's annual report, all 283 bloody pages, it's like a telephone directory. If you check page 121 to 123, which I did, basically the share appraisal rights, which were awarded to management, their anniversary was due. And because Rainbow is incredibly illiquid, because Rembrandt owns 80% and the top three shareholders own another 10, as management was selling some of their share appraisal rights to meet their tax obligations and to raise a bit of cash, that stock was basically an overhang in the marketplace, and the share price basically fell as that stock was absorbed. That stock has now been absorbed, and in the last few days, the stock is up from 4.03 to 4.25. And I'm of a very, very strong opinion that in the coming weeks, with the Astral results in the system and the trading update ahead, that the Rainbow share price trading at 4.25 will start to move back towards its recent 52-week high, which is 4.85. My target price of Astral Foods, again, as I mentioned earlier, was 220, and my target for Rainbow was 500. Both of those stocks are knocking or did knock on the door of my target prices. I will be upgrading my Astral share price to 250 Rand, and I have upgraded my Rainbow target to 6.50 Rand. So as it stands right now, if my prognosis for the poultry sector rings true, if you've lost the easy money in the short term in Astral Foods, because I hate chasing stocks when the easy money has been made. I was buying the stock on behalf of my clients between 150 and 165 only a matter of a month to 6 weeks ago. And we're now knocking on the door of 215 Rand and some change. I think that Rainbow at 425, there's still nice upside. So as it stands right now, I can easily see a 15 or 20% upside in Rainbow Chickens coming in the coming couple of months towards the end of the year. So as it stands right now, my first special situation is Rainbow Chickens at 425, and that will feed in due to the very succulent trading update and results that I'm expecting from Astral Foods literally in the coming days and weeks. I'm just checking the questions here. They're coming in thick and fast. Keep them coming. My next special situation is a sector that I followed for the best part of 30 years, which is education. I think on my last webinar, in fact, and on most webinars year to date, I've discussed Avitec, Kuro, and Stadio. Now, Curro is dropping off my radar because, as you may realize, the Pitmerton Family Trust came out and bid 13 Rand a share to take the company private. And that basically saved the company's bacon because the recent results were nothing to write home about. And as I've written extensively this year, where I've had Curro as the worst performing stock in my private education landscape. If it wasn't for the buyout, I thought I would have seen the share price trending well below 8, probably getting towards 6. So basically, the Mouton Family Trust taking the company into private ownership, which is a very noble and philanthropic endeavor for the family, has basically saved the company's bacon. My long-standing call in private education has been Stadio, where I have a documented scenario saying if I only had to own one education stock in the longer term, it would be Stadio. And year to date, that stock is up 52%, whereas Avitec is down 6.53. Now, there is nothing wrong with Avitec, and I'm going to come to my special situation right now, which will be Avitec. Looking at the price earnings ratio, Avitec's on a 15.6 and Stadio's on a 33.4. Now, Stadio does have faster growth, but it's not materially faster than Avitec. Avitec consistently for the last few years has shown growth between 16 and 20%, averaging around 18, where Stadio has been in the, call it the mid 20s. So you've got a company trading on a 50% discount to Stadio, where the growth has been fairly reasonable. It's got a cast iron balance sheet. It pays you good dividends. It's got a mix in schooling, in tertiary, and a very strong growing African footprint, and with expansion endeavors into territories above and beyond Ethiopia, Ghana, Botswana, South Africa, and latterly other countries it is looking at. So I've engaged with all of the free education stocks in reporting periods because they were all June interim results. The best result came from Stadio, understandably so, which is why the share price was running. The second best result came from Avitec, up about 16 to 17%, and the worst was from Curro. But as I said, Curro's bacon was basically saved by the buyout. So Avitec trading at 31 Rand 52 is down 6.53% year to date. And that is a combination of a number of factors. One, we've had some selling at the start of this year by one of its large shareholders, Value Capital Partners, which basically sold half its stake, from around 10% to about 6%. Then the PIC was selling, and I think there is a little bit of an overhang in the stock, and the fact that it's not directly a pure play. Even though the majority of the revenue and the earnings come from education, there is still an element that comes from resourcing, which is basically an employment agency mainly in Africa. And Avitec, for a number of years, has been reluctant to sell that business. Its rationale has been that it is not much effort to run. It makes reasonable earnings, but it's like having a business which is not a pure business. And I think the market would be substantially happier if they were to sell resourcing and pull out a chunk of change of between 5 and 800 million Rand and reinvest that back into the business, which I think in some point they will do. So Avitec to me is a bit like my call on Invicta in August. I track companies extremely closely, and Avitec for the last 6 to 9 months has trended sideways. I'm not a big technical analyst, I'm not that clever, but I look at companies fundamentally, and if it's augmented by the technical analysis, then it gives me a little heads up. I'm absolutely convinced that at some point, perhaps tied into the next results of Avitec at the December year end, but given the differential between Avitec and Stadio regarding its valuation and the share price performance, that Avitec has to play a period of catch up. So if the stock breaks 33 Rand, I can easily see the stock going to 38 and then 42. And I've written that fairly recently in my analysis on the sector. But whilst I still really like Stadio, at 10 Rand 50, the stock is priced to perfection. Now, do I believe that the next set of results to December and the results into 2026 and 2027 will continue to be strong? The answer is yes. But when I see a stock at 10 Rand 50, a new record high, on a P of 33, even though that PE will unwind with strong earnings growth to the end of this year and next year, I get concerned that when a stock is priced to perfection, if anything comes out and rattles the marketplace, you're on a hiding to nothing. Do I expect some form of disruption in the Stadio share price? No, I don't. But I'm always reluctant to chase a stock when it's up 52% in the last 12 months and it's doubled since the AGM in June 2024. So right now, my call would be to look at Advatec as a proxy on the education sector. You've got a very well-run schooling operation. You've got a very well-run tertiary operation, not just in this country and in Africa. The company has a cast iron balance sheet. It pays really good dividends. Management are very astute and they're seasoned in running a very well-regarded education operation with growth touch points, not just domestically, but also externally. They are growing their online operation inside tertiary extremely fast. It does not concern me that the growth in Advatec's tertiary operation might impinge on Stadio because there is enough demand in the domestic marketplace with the lack of available spaces in the state system and the fact that UNISA's reputation is falling in a heap and the ability to leverage off their existing platforms to offer tertiary qualifications into any other English-speaking territory, not just in Africa, but internationally, to keep both Advatec and Stadio's tertiary performing exceptionally well for years to come. But purely on a valuations basis and the fact that I believe that at some point Advatec wants to play catch-up, my second special situation in this webinar is Advatec. And then I'm going to come on to my third special situation, which is Kal Group, or formerly known as Carp Agri. I wrote a note on Carp Agri last week for my institutional clients because part of the work that I do is preempting results and my expectations for what I think the market is either missing or the fact that I believe in KAL's case, the market does not understand the company, and I'm expecting a really good voluntary update to come. And results from Kal Group normally are released to the market at the end of November. At the interim stage, earnings were down just under 4%. And on a comparative basis to September 2024, they were down just over 9%. Now, that may not sound compelling. You've got a stock trading on a P currently of 7.6, and the last two sets of earnings were both negative, albeit modest negative. But again, I've covered Kal Group or Carp Agri for the best part of 20 years. And as I put a chart on my Small Talk Daily Twitter X page last week, if you track every single interim and final and dividend payment that Kal Group has done for the last 20 years, it has been a steady growth in earnings for the best part of 20 years. Only 2024 did we see a speed wobble where we saw a glitch because in that year we saw a dramatic decline in the petrol price, and as such Carp Agri wasn't making as much money on stock profits on fuel. We had a very constrained consumer environment where the demand for convenience store products and other retail elements inside Carp Agri took a bit of a hit, despite the fact that the agricultural side, which makes up roughly about 25 to 27% of their trading profit, was extremely strong. That was not enough to offset a weaker fuel and convenience store side. But that, to me, was a one-hit speed wobble. Despite the fact that the interim earnings were down, as I said, about 4%, it is my expectation we've had an extremely strong, I would dare say, bumper second half. Fuel sales are up, albeit modestly. Convenience store sales, I believe, are up. And the agricultural side has been incredibly strong, with capex from the fruit farmers, particularly the Western and Eastern Cape, at record levels. This has all fed through into a significantly increased level of earnings activity in Carp Agri. And as I put in my note last week, I'm expecting growth probably between 625 to 650 in earnings per share, which is up roughly about 14 to 15% year on year. I'm expecting a substantial improvement in the dividend payout because the debt situation inside Carp Agri's debtor book, which is extremely well managed, and in fact, the bad and doubtful debts inside Kal Group would make any retailer wince because it is so good, is at a 15-year low. And as such, I'm expecting an uplift in the dividend payment. And I think the speed wobble we saw in earnings in 2024 will reverse, and Carp Agri or Kal Group will go back to its consistent long-term CAGR, which is compound average growth rate of around 15% per annum. So when I see a stock trading at 42 Rand 70 on a P of 7.6, and following the recent sale of its agricultural manufacturing interests for 317 million Rand, which equates to about 4 Rand 26 a share, or around 10% of a company's current market cap. Allied to what I've just told you about earnings uplift and the improved financial situation and the dividend payout, to me, the stock is looking extremely well priced. Now, the stock has started to run. Again, the easy money was made. I've had a buy on Carp Agri for quite some time. I had a piece in the Financial Mail a few months ago at about 36, 37 Rand, with a target price of about 45 to 48. And I reaffirmed that in my own institutional note about a week ago. So the stock hit a low of about 36 Rand on the 17th of September, and it's up 16% since then. I think the market has started to see what I saw quite a few months ago, that the stock is having a better operating performance. That'll feed through into earnings and then dividend, and then the market always looks through into next year. So at 42 Rand 70, which is where the stock closed yesterday, down 16% year to date, but it was down about 26 to 28%. My target price remains 48 Rand, and I think it'll get there during the course of the end of this year, and then into next year, 54 Rand. So my third special situation is Kal Group. So my first, as a reminder, was Rainbow Chickens at 425. My second is Advotech at 31 Rand 52. And my third is Kal Group at 42 Rand 70. I think those three will all have a very good underlying performance for the next 6 or 12 months. I'm keeping an eye on my time here. It is 10 past 7. Let me quickly scroll through the questions, see what is coming in. Okay, get those questions in. In the next 5 or 6 minutes, I'll be moving on to Q&A. I want to mention a couple of other stocks which I know are extremely widely held by the private client shareholder base of Rand Swiss, and one would be Afremat. Afremat year to date is down 46%. I had a sell on Afremat. It was July the 18th last year at 71 Rand 52. Did I believe it would get to 38 Rand 25? No, I didn't, but it has. A combination of missteps, most not of a company's doing, saw a complete collapse in the company's earnings. And that has seen a dramatic unwind in the share price and the underlying rating of a company. For a stock that was, quite frankly, for many years, a shareholder and market darling, it is no longer a market darling. It has had significant criticism in the last 6 months, and I don't think that's going to change anytime soon. There was a site visit to the Lichtenberg cement operation of Lafarge, which is owned by Afremat, a few weeks ago, which I attended. It was a very, very well attended site visit. I was one of the very few sell-side analysts participating. Most of the participants were fund managers and institutional shareholders. and it's always nice to kick the tires to go and see uh, an underlying operation of a company. And you also get to hear the views of the underlying clients and shareholders that own it. So what was my high-level view of Afremat and Lafarge? Well, if you would have read the Financial Mail last week when I had a one-page company review on Afremat, I still think it has some work to do. I said, sadly, the company is still wearing concrete boots, and the earnings are certainly not going to see any form of material recovery until at least the second half of 2026, and it'll only be into 2027 where earnings, I believe, will get back to where they were in 2024. And that's one of the reasons why the share price is lackluster at 38 Rand 25. Now, the cement operation, which lost 285 million Rand last year, has broken even and made a small profit in July and August. That was evident from a site visit, and that did cheer up the marketplace. But there's still some work to be done. The plant is operating in what I would call a much more reliable fashion, but management were at pains to point out the underlying utilization of a plant needs to increase by at least a third to get better operational activity and costs into the business to improve margins. And then the underlying output of clinker, which is the main product that is ground that makes cement, which is currently 1 million tons a year, needs to uplift by at least 50% to 1.5 million tons again to make a decent return. So as an old operating hand, if I see a company which granted is doing materially better than it was, with a plant that is turning the corner, but has a 33% uplift in its operating efficiency yet to undertake, and a 50% operating uplift in its volume production, that is not going to happen overnight. That'll probably take at least 6 to 12 months to undertake, and as such, a market will have to wait patiently for the type of decent returns that the cement production will accrue to Afremat. And as such, with the iron ore price fairly benign at about $104 a ton, the rand being materially stronger year to date, impacting the export levels, and the fact that there is still concern that Afremat is tying itself ever more deeply into ArcelorMittal with supply contracts of iron ore and other materials. There is genuine concern that whilst the corner may have been turned in Afremat, the market is waiting to see when the underlying earnings turn will take. So I'm expecting a very good uplift in the interim number. Now, be under no illusion, Afremat will report a substantially better interim result to its August period. Results are coming out on the 23rd of October. Now, they reported 53 cents to August 2024, and I'm expecting an uplift to maybe around 80 cents this year. So on a percentage basis, it is a fantastic improvement. But if I told you from memory that Afremat's normal interim earnings are generally between 2 Rand 50 and 2 Rand 80, however mighty have fallen. I'm forecasting earnings growth for February 2026 of between 3 Rand and 3 Rand 50, which again is a material uplift on the 72 cents they made this year. But it comes off a base of 5 Rand 67. So again, it shows you the depth of the fall of the Afremat earnings, with the fact that debt is sitting at 1.66 billion Rand, which has not come down because of working capital requirements of other parts of the business. You've got the cement business that has yet to fully turn the corner and basically cover its nose of profit. And then you've got substantial investment made in the phosphate business, Glenover, which is making a loss. And the iron ore side is showing substantial improvement, but a lot of the luster has been taken off because of a stronger rand. And as such, whilst I truly believe that at 38 Rand 25, we are near the bottom of Afremat, given that the private clients have the ability to finesse their orders, unlike, let's say, a large institution like Coronation or Allen Gray or Old Mutual as examples, who have to be in the market every single day to get an average to build up a certain stake, a private client has the luxury of timing. And as such, I would be much happier buying Afremat between 36 and 37 Rand on an off day than paying 38 Rand 25. Now, the stock has trended as low as about 36 Rand 50 in the last week or two. So if I could see the stock maybe 5 or 6% lower, and I would be patient for 6 or 12 months, I can see a target price of Afremat on a 12-month view of between 45 and 48 Rand. Now, that is not a bad clip if I were to be patient and live with the risk that perhaps the stock may weaken a little bit more in the coming weeks and months due to concerns about the underlying operations. But make no doubt, I think we are near the bottom. We are not over the worst of the operational aspects inside Afremat, as long as debt is high and as long as there is volatility in iron ore and concerns regarding the operational effectiveness of the plant in Lichtenberg, amongst other issues. I do not see Afremat suddenly having a hard run, but I think we are near the bottom of the stock. So at 38 Rand 25, it will be a special situation, but I'm saying it's all about finessing your entry point. So put Afremat on your watch list, and if you see it weakening on an off day, I would certainly tuck some away on a 12-month view. And I think you could easily see a 25 or 30% uplift on a 12-month scenario. So to run through once again my 4 special situations in this presentation, it is Rainbow at 425, it is Avatec at 31 Rand 52, it is Kal Group at 42 Rand 70, and it is Afremat at 38 Rand 25. But in Afremat, time your input price. I had many more stocks to discuss, like Argent and Novus and Combined Motor Holdings and CA Sales, but with time against me, and I did say I'd get to questions, I'm going to have a look at the Q&A and have a quick look to see what is going on. Robert McIntyre, your question, Nampak, do you think the departure of Andrew Hood is genuine, or is it indicative of something of concern of a company? Now, if you heard my preamble earlier on Nampak when I was talking about the stock in my top 10, as I said, I'm formerly a corporate broker, and in corporate broking, you often get information which is above and beyond what is normally disclosed to the market. Not that it is privy, but in certain instances, it is not the market's right to know what I would consider a personal matter. And I'm going to relay a couple of instances for you without actually naming names. But it'll give you an indication, Robert, as to why a sudden departure of an executive, particularly before year-end results, can raise the ire and concern of the marketplace, but often there are genuine, heartfelt reasons why an executive has to leave. And I'm going to give you 2 examples without naming names. In my corporate broking past, there was a sudden departure the day before the result of a CEO, of a CFO of a very well-known food company. Now, if a chief financial officer steps down the day before a financial result, the market usually thinks there is shit going to hit the fan. There wasn't. What the Sens could not say is that the CFO's daughter had been involved in a horrific car crash and was in a coma. And as such, understandably, the father wanted to be at the bedside of his daughter in this tragic situation. Another situation where an executive stepped down and was selling shares aggressively. What was not commonly known in the marketplace, that he was going through an extremely acrimonious and very bitter divorce, which was tearing the family apart. You can't put that in a sense. But as a corporate broker, I get to know these things, and I can then calm my clients down by saying, listen, there's a genuine reason why an executive leaves. In the case of Andrew Hood, I would say there is a genuine reason why he left, and it is not my case to indicate what that is, but the fact that the company has swiftly resolved that issue and appointed Rian Hale as the heir apparent to take over from Phil Roux in February 2026 should give a market cause for comfort that the market was listened to, and an experienced, seasoned executive with FMCG experience was appointed in the role. Robert, I hope that gives you some context. Often why an executive suddenly steps down. It's not often bad news. Sometimes it is a genuine heartbreak. Mohammed, you say, I've been a happy holder of CMH since the late 1990s, but I'm starting to worry that his lunch is going to be eaten by online operators. It doesn't seem as if they are rising to the challenge. That is an extremely interesting question. CMH makes a fair chunk of its money, not just in motor retailing, but from financial services, aftermarket parts, motor vehicle servicing, and of course, car rental, where its first car rental is one of the leading car rental agencies in this country. And we're about to move into the second half of the year where tourists flood into this country and they all make very good money. So, in CMH's case, your question does have validity, but not as much as you may think. CMH, as you know, has the exclusive rights to the Suzuki franchise. They also have the exclusive rights to the Photon brand of commercial vehicle and Bucky coming out of China. Now, if you see the NAMSA stats, which I do on a monthly basis, which is new car sales, the Suzuki is the second best selling car in this country. It's overtaken Volkswagen for the last few months because the consumer wants affordable vehicles with all the bells and whistles, which is why Chinese or Indian made cars are now taking the market share of most of the new cars sold in this country. Anecdotally, as I'm sure many listeners online would share, many of my friends have bought new cars in the last few months. Every single one of my friends have bought a Cherry, a Haval, an Omodo. It's a Chinese vehicle or a Suzuki. Nobody that I know has bought a Volkswagen or a Toyota or a BMW or a Mercedes, showing you how the market has changed. So CMH having the exclusive rights to one of the top selling cars in the country, and Photon has taken the market by storm regarding sales in the commercial vehicle sector, I think insulates the company to a certain degree regarding the changes that is going on in the marketplace. Now, again, to be logically, would you really do your entire purchase of a new car online? Everyone likes to feel, touch, see the quality of a car, open and close the door, check the operating features, check the paint color, and what I would call the old-fashioned kick the tires. And as such, they'll probably go into the dealership to look at the vehicle, but they then may order online. So I get what you're saying regarding online ordering, but I don't think that the majority of customers in this country would ultimately buy online. We still see that We Buy Cars is opening up these monster showrooms around the country where you can physically go in and check the car if it's got a ding or a dent or a scratch, and to check the odometer and if the seat has got a cigarette burn, etc., etc., etc. I think consumers are predisposed to basically going out on big ticket items and basically looking at a product. It's different when you're buying a shirt or stationery or something that you can easily understand. But I think on a big ticket item like a house or a car, consumers still want to physically go to the vehicle, go to the house, and check what is going on. Now, interestingly, in CMH's case, I was doing the numbers earlier. It was one of my talking points. Their market cap is 2.2 billion rand. And they had a trading update which came out a few days ago, which was extremely good. Earnings are going to be up between 20 and 25%. But above and beyond that, they are sitting on bucket loads of cash. And the last set of results, from memory, they were sitting on about 950 million rand of cash. I believe that has gone up substantially. And it is my view that cash is now over 40% of the market cap of CMH. Now, Jeb McIntosh, the CEO, who's 80 in the next financial year, and I think he'll be retiring at some point, and a new CEO will be appointed. You do not need over R1 billion of cash to run a motor retailing business or a car rental company. You need to have a certain float, but it certainly isn't over R1 billion. I will go on a limb, pregnant pause, and say that in the next 6 or 12 months, either at the interim results or the final results to February, but a special dividend will come from CMH to try and pay out that large cash hoard. And let's not forget that management own about 42% of the company. So that if they pay out this cash, a large chunk goes back to itself. So Mohammed, I hope that my answer on CMH, which is trading at 33 Rand and on a very, very inexpensive PE if you strip out the cash, still to my mind looks attractive. I own CMH myself, and my target price of the stock is 42 Rand. Let me just quickly scroll through in the dying embers of my presentation. Jeff, hello Jeff. Would you buy PPC at these levels? Your views? Well, as I said, PPC is in my top stocks. It is up about 12-13% year to date. I wouldn't run out and buy it. I'm always of the ilk that when the easy money has been made, I hate chasing stocks. Now, is Matthias Caldarelli, the CEO of PPC, doing a fantastic job in reawakening the giant? Yes. But the underlying cement market in this country remains subdued. You've seen that in the PPC numbers and in the numbers coming out from large cement retailers like Cashbuilt. Much of the gain in PPC has come from a deleveraging of the balance sheet, asset sales, and efficiencies. Now, that can continue, but we need economic growth in the underlying economy and an uplift in pricing and cement sales for PPC and the other listed companies like Sapaku and even Afremat to make a reasonable return on their investment. So at about £5.50, I would not be chasing PPC, even though I think its underlying target price in the long run is around £8.50. Another CMH, we've just answered that. I've mentioned Rainbow Chickens. I've mentioned Cashbuilt in my preamble in my top 10. Another Cashbuilt question. A question on Purple and We Buy Cars. Sadly, I don't cover Purple, and We Buy Cars is not a stock that I've got an opinion on because I have not been covering it long enough. Orion Minerals, anonymous attendee. I do not cover resource companies, so sadly, I do not cover Orion. Another anonymous question. Would you hold Stadio if you have it? I do hold Stadio. I've made good money. And as I've said in my preamble earlier on Avatech and private education, if I only had to own one stock longer term, it would be Stadio. But at £10.50, it is up 52% year to date. It has doubled in a year. It is priced to perfection, but it generates significant cash flow. It pays out rock solid dividends. It'll never have a rights issue, and it's got plenty of headroom to grow. It's in a great space for the next 2 to 3 years. So I would have no hesitation. If I owned it, I would hold it. But would I run out and put my hard-earned money in at £10.50? The answer is no, because the easy money has been made. If it was a rand cheaper, I probably would. A question from Robert again. Do you know why Nampak Zimbabwe fell through? No, I don't. I think the perception I got in speaking to the company is that the purchaser simply couldn't get their ducks in a row regarding the timing of their ability to pay. And as such, the timeline regarding the transaction for the deal to reach finality just basically ran out. But as I asked the company, what now? And they said to me, Anthony, we always have a plan B. So I think given that Nampak is a September year end, I would certainly look at results coming out in the next couple of months to see what plan B actually is. My last question. Any views target price for Libstar potential takeout? I wrote an extremely detailed note on Libstar to my clients about 2 weeks ago. Those which have long memories will remember that I had a buy on Libstar at the start of 2024. It was my special situation wildcard in my top stocks at £3.30 with a £5 target price. I made my target. It was up 50%. And then with crappy earnings that came out at the end of last year, the share price fell all the way back but I still reiterated my view that the stock was ripe for a breakup or a takeout. And you saw a few weeks ago, a few months ago, the company basically put the for sale sign on the head office. Now, here is where it becomes interesting. Again, as a former corporate broker, I get to know far too much for my own good. It's the nature of the universe that I operate in. And particularly having been in the market for 30 years and having very wide and deep relationships across the food sector, and of course, with my institutional clients who happen to be Libstar shareholders. I believe that many institutional shareholders want about £7.50 for their Libstar stake. No one in their right mind is going to pay £7.50 when the stock was trading at £3 only a few months ago. So I think if a takeout were to come, it would be between £5.50 and £6, which I think is an amiably fair price. I've seen some pricing out there by some individuals on social media who thinks Libstar is worth 10 Rand. 10 Rand in what universe? If you actually did a deep dive into Libstar, and if you knew what I knew about the company, you certainly wouldn't pay 10 Rand. Take a much harder look at some of the lease liabilities, who owns the property, and some of the issues regarding some of the underlying operating assets inside Libstar and the underlying margins that some of their big divisions actually get. It is actually pitiful, some of the underlying margins that their big divisions actually get. Is it a breakup play? Yes. Do I think it'll be broken up? No. I think it'll be bought by somebody and then assets sold off piecemeal. So as it stands right now, as I wrote to my clients a few weeks ago, I would lay a 50-50 odd that Libstar will get taken out, and I think a price between £5.50 and £6 is a fair price. Do I think it will? Do I think it will get taken out? 50-50. I think, again, knowing the market as I do and knowing how private equity players and listed entities like to play, no one in their right mind is going to pay a 100 to 150% premium to VWAP, which is where Libstar was trading before the cautionary to take this company out. It does not happen in anyone's universe if you understand the underlying operating metrics of Libstar. A fair price to me is £5 to £6, but again, institutions won't accept that, which is why I think the deal, in theory, might even fall through. So that's why I put a 50-50 scenario on Libstar. On that note, ladies and gentlemen sitting there in the dark, it has now gone 7:30. So on behalf of myself here, Anthony Clark at Small Talk Daily, if you haven't followed me on social media, please do. My Twitter page is often packed full of interesting tidbits and revelations that I often make privy. At Small Talk Daily, please give me a follow. And until the next time, which will probably be towards the end of this year, where we'll see how my special situations that I've regaled to you will have performed. And I might even touch base as to what selections I will have for my top stocks of last year. And as we close 2025, I will see how my top stocks of 2025 have actually performed. But thank you one and all for listening in, and keep a very close eye out on the Rand Swiss website and their social media page, because the YouTube of this webinar will be up in the following days. Good night, one and all. Keep safe, keep warm, and I'll chat to you again soon. Take care.